Hi, everybody. In this video, I wanted to introduce the beginnings of Chapter 9, which is about the process of capital budgeting, and in fact, it's titled Investment Decision-Making Criteria, and that's the overview of the chapter, I guess. In the chapter, the textbook covers several different techniques for deciding whether a particular investment project is a good idea or a bad idea. And really, that's what we've been building up to through the whole semester. We've developed a bunch of tools like the cost of capital and present value of annuity and other topics that we've seen throughout the course, and they all feed into this process. So the purpose of Chapter 9 is to show several different ways of bringing that information together and making a decision. There are 6 of them outlined in the chapter, and we're only going to talk about 3 of them, actually. And they're highlighted here in this outline. The net present value is the first one we'll talk about, and probably the best and most important. We will talk about payback period, or the payback rule, and we will talk about internal rate of return. You'll see these latter 2 in a couple of later videos. The others that appear in the chapter, the discounted payback, average accounting return, we will not worry about, and those profitability index as well. Those topics have been excluded from the reading assignment. I may mention why, as we go along, why we're not bothering with those, but in any case, you don't have to be responsible for any calculations that relate to those sections of the textbook. Each of the criteria or the ways of making that decision are evaluated in the chapter in terms of three standards, I guess. First of all, when we make a decision, does that decision rule account for the time value of money? Does it correctly reflect the fact that cash flows that occur in the future are less valuable than cash flows that occur today or in the near term? Time value of money. We learned about that in chapters 5 and 6, and any decision rule, any process that we use to make investment decisions has to account for that. Similarly, does the rule adjust for risk? Does it correctly reflect the fact that everybody is risk averse. Human beings are risk averse. We have to be compensated if we're going to take on any sort of financial risk, compensated in the form of a higher rate of return. And if you make an investment decision ignoring the risk of the investment, that can lead to some bad outcomes. So we want to make sure that's the case as well. And ultimately, we said in Chapter 1, the purpose or the goal of financial management is to make decisions in such a way that the company creates value, that the company becomes more valuable than it was before we made the investment. Value creation is the overarching goal of financial management, and that's what we want to know. Does the project create value for the firm? That's what we're trying to find out. So ultimately, that's what any decision rule has to accomplish. I'll talk in this video about the first of these 3. First one being net present value. One of the things I don't like too much about this chapter is that it kind of telegraphs the punchline, meaning that the first one we cover is really the best, the most direct, and we will see why that's the case in a few moments here. I've introduced this concept of net present value in previous chapters. We saw it as far back as Chapter 6, where we were dealing with uneven cash flows. I think we saw it again in the context of Chapter 8, where we were talking about stock valuation with irregular dividends, non-constant growth in dividends. And we used the concept of net present value in those contexts without thinking too much about it. But let's define it here. Ultimately, the net present value of an investment is really just the difference between the market value of a project and the cost of acquiring it. We can imagine an investment project in terms of its cash flows on a timeline. I'll just draw a simple one here. Say we invest $1,000 into some piece of equipment, and we expect that it'll generate benefits amounting to 300, 400, and 500 over the next 3 years. Is it a good investment or is it not? Well, ultimately, what determines that is whether the benefits of owning that project, meaning the cash flows that come back from the investment, outweigh the costs of obtaining it, the cost being the $1,000 initial investment. We do need to know that those expected future cash flows outweigh the costs in terms of their present value. Remember that any cash flows that occur in the future are less valuable than cash flows occurring today, so we need to compare the incoming cash flows in terms of their value today to the cost that we incur today. And it's very simple conceptually. It's a very simple idea. The net present value is simply the present value of the benefits of a project minus the present value of the costs of obtaining it. Simple as that. And my example here, the $1,000 is already happening today, so that's already present value. It's these future cash flows we have to discount to account for this. Ultimately, that tells us exactly what we want to know. How much value is created from undertaking this investment? That's exactly what we're hoping to figure out, and net present value is a very effective way of determining that. Here's another slightly more realistic example, not much more realistic, I guess. It's still just one investment and 3 cash flows, all of different amounts. We'll talk in Chapter 10 about the process of estimating these cash flows, figuring out where these numbers come from. But for now, just take them as given. We're told that this project costs $165,000 to invest in it, and will generate cash flows of these amounts: $63,120 in the first year, $70,800 in the second year, $91,080 in the third year. So we want to discount those future cash flows, find their present value. We need a discount rate for that. That's what we learned about in Chapter 14. Skipping ahead a little bit, but we developed this concept of the weighted average cost of capital, and that was what we said was the hurdle rate for a typical investment for a corporation like this. The minimum rate of return it must generate in order to be considered acceptable. And that's how we're using it here. This 12%, well, think of it as what our cost of capital or weighted average cost of capital is, the hurdle rate for the investment. We'll make the calculations here in a second, but ultimately the decision rule is this: if the net present value is positive, accept the project. Think about it. Go back a couple of slides here. I said the net present value of a project was the present value of its benefits minus the present value of its costs. If the benefits outweigh the costs, the difference will be positive. If the costs outweigh the benefits, the difference will be negative. Simple as that. So when we calculate this number, the net present value, as long as it's bigger than 0, it's a good project. It means the benefits outweigh the costs. It means the project will add value to the company and, well, therefore increase the wealth, the benefit to the owners of the company. And that was the goal of financial management. We wanted to make decisions that have the effect of maximizing the company's value. And if we can make every investment that creates value for the company, that's what we'll do. Process is pretty easy. I've shown it here in terms of mathematical formulas, which you probably don't want to implement, but well, you see what's happening here. We take the original cost, negative, paying out $165,000 to buy this project, adding to it the present value of the first year's cash flow plus the present value over 2 years of the second year's cash flow and the present value over 3 years of the third year's cash flow. If you didn't have a financial calculator or a spreadsheet, you could answer the question this way, and this answer is correct. I see a positive number here. The result comes out without a minus sign attached. So this $12,627 is the value that's created by taking on this investment. Basically, we are taking $165,000 of the company's money and buying something or investing in something that generates cash flows, which are today worth $177,627, I guess, trying to add in my head this number and this number, but I think that's about right. Taking $165,000 and creating an asset that's worth $177,000 and change. That's creating value. It's a lot easier to do with a spreadsheet. Typically, you would just lay out the cash flows. I kind of like horizontally, kind of like a timeline here, although you can do this vertically as well. That's the time zero cash flow, year 1, year 2, year 3. Make sure your time zero cash flow is negative to indicate that it's an outflow. There's a formula for this. It's we've used it before, the NPV or net present value formula. And you can just give it the range of incoming cash flows. I will emphasize here that the NPV formula doesn't always work the way people expect it to work. Notice that I've given it here, first of all, the discount rate. That was this 12% in cell J1 in this worksheet. That's the cost of capital, the hurdle rate, the discount rate that's applied to those future cash flows. And then I've given it a range of cells here, J4 through N4. That is these numbers right here. Well, it extends out to column N, but we have zeros in columns M and N. Really only need to go through L4. But in any case, it captures those numbers, the future cash flows. I've left off the initial cost, which is in cell I4. It's the $165,000. I've left it out of the NPV formula and added it here, added that negative value to the end. It's a little bit of a quirk in the way Excel and Google Sheets handle this net present value NPV formula, in that it assumes the cash flows that you give it start 1 year in the future. If you had just said, for example, equals NPV with J1 and then I4 through N4, for example, you'd get a wrong answer. Slightly off, because that initial cost, you'd be including this initial cost in cell I4, which happens today, not 1 year from now. You would get a number that was lower than what the true answer to the question is. So be careful with that when you use the NPV formula in a worksheet. If you're using a financial calculator, things are a little bit different. I may do a separate video if there's any interest to show the process of answering this with a financial calculator. NPV is pretty easy to understand. Clearly the answer here came out to be $627.41, just as it did above. So we're consistent with the answer, and that would seem to be right. Do we accept or reject? We accept. That number is positive. As long as it's 1 penny or greater, if it's a positive number, it means that the benefits of the project outweigh the costs, and it should be accepted. Look for the next video on the payback period and on the internal rate of return criteria coming up a bit later.